before we go any further, I want you to do something simple. Think about the last time you saw a stock suddenly rise or fall. Not slowly, not gradually, suddenly. And ask yourself honestly, did you really know why it moved? Most people don't. They guess. They assume. They follow explanations given after the move has already happened. In this episode, that guessing ends, because once you understand who actually moves stock prices, the market stops feeling confusing, unfair, or random. It starts feeling structured. Why understanding price movement comes before everything else. Many beginners jump straight into indicators, strategies, stock tips, buy and sell levels, without understanding price behavior itself. That is like trying to drive a car without knowing who controls the steering, how brakes work, how fuel is consumed. You may move for some time, but eventually something breaks. Price movement is the language of the market. If you don't understand who speaks that language, nothing else works consistently. The only direct cause of price movement. No matter which market you look at, India, the US, Europe, or anywhere else, the rule is the same. A stock price moves because of imbalance. More buyers than sellers, price rises. More sellers than buyers, price falls. There is no other direct cause. News, results, announcements, and events do not move prices on their own. They only influence decisions. Decisions create orders. Orders create imbalance. Imbalance moves price. The market is a place of decisions, not information. Most people think markets reward information. They don't. Markets reward positioning before information becomes obvious. By the time something is widely discussed, price has already adjusted. That is why understanding participants matters more than reading headlines. The three groups that exist in every market. Every stock market has three main groups. They exist in every country, every exchange, and every asset class. Retail participants. These are individual investors and traders. They usually invest personal savings, rely on public information, act independently, and enter with emotional expectations. Retail participants react to what they see. They buy when something feels safe. They sell when something feels scary. Institutional participants. These include mutual funds, insurance companies, pension funds, banks, and large investment firms. They manage other people's money. Their focus is capital preservation, steady growth, risk control, and long-term positioning. Institutions do not react quickly. They plan carefully. Professional or smart money participants. This group focuses on timing, liquidity, and behavior. They understand when participation is high, when emotion is extreme, when price is vulnerable. They don't need to predict. They observe and act. Who actually has the power to move prices? Price movement requires volume. Volume requires capital. Large, sustained price movement is not possible without large money. Retail money is divided across millions of participants. Institutional money is concentrated. That concentration gives institutions influence over direction. Retail participants do not start major trends. They join them, often late. Why retail participants feel invisible. Retail participants often feel ignored by the market. They say, I bought, but nothing happened. I sold, and then it went up. This is not personal. Individual actions are too small to affect price. Markets respond to collective behavior, not individual intent. Once you accept this, frustration reduces. How a price move actually begins. Most major price moves begin quietly. There is no excitement, no urgency, no headlines. Institutions begin accumulating gradually. They do this carefully because aggressive buying increases price, rising price attracts attention. They want positions, not attention. During this phase, price moves sideways, volume looks normal, interest is low. This phase is invisible to most retail participants. Why sudden moves feel shocking. Once accumulation is complete, price begins to move faster. That movement attracts attention. People start noticing unusual activity, sharp candles, increasing volume. Only now does curiosity begin. By the time excitement appears, a large part of the move is already complete. This is why many people say it moved suddenly. In reality, it moved after preparation. Why public explanations feel unsatisfying. After price moves, explanations appear. These explanations feel logical but incomplete. They describe what happened, not why it was positioned. Markets move first, stories follow later. Stories help people feel comfortable, not profitable. Why expectations matter more than results. Markets move on expectations. If something good is expected and it happens, price may not rise. If something bad is expected and it doesn't happen, price may rise. This confuses beginners. They focus on outcomes. Markets focus on the difference between expectation and reality. Understanding this removes confusion. The role of liquidity in price movement. Liquidity is essential. Large participants need buyers when they sell, sellers when they buy. High participation creates liquidity. High participation usually appears during excitement, fear, panic, or euphoria. These emotional states are not random. They are part of market structure. Why emotions peak at the wrong time. Retail emotions follow price. Price rises, confidence increases. Price falls, fear increases. But price often reverses when emotions peak. That is why buying feels easiest near tops, selling feels necessary near bottoms. Markets move opposite to comfort. Why the market feels unfair to beginners. Many beginners believe the market is unfair. In reality, the market is indifferent. It does not care about your entry, your exit, or your expectations. It only reflects collective behavior. Once you accept that it is unfair, learning accelerates. Why patience becomes a competitive advantage. Institutions are patient because they can be. Retail participants feel pressure to act, to participate, to not miss out. That pressure creates mistakes. Patience allows better entries, calmer decisions, fewer emotional errors. Time is not just money. Time is protection. What this understanding changes in your thinking. After this episode, something important should shift. You stop asking, which stock should I buy today? You start asking, who is active here and why? You stop reacting to every move. You start observing behavior. This is how consistency begins. A quiet truth about the market. Markets do not punish ignorance. They simply do not reward it. Losses are not personal, they are educational. Those who stay long enough and learn correctly stop repeating the same mistakes. Why this knowledge must come before strategies. Without understanding participants, indicators feel unreliable, patterns feel random, confidence disappears quickly. With this understanding, patterns make sense, risk becomes manageable, decisions slow down. Slower decisions are often better decisions. Preparing for what comes next. Now that you understand who moves prices, why news feels late, why emotion matters, the next step is understanding market phases. Markets do not move randomly. They move in cycles. These cycles repeat across time, countries, and asset classes. Once cycles become visible, panic disappears. A moment of reflection. If you are still listening, it means something important. It means you are not looking for shortcuts. You are looking for understanding. That alone places you ahead of most participants. Final thought. The stock market is not designed to confuse you. It is designed to reflect behavior. When you understand behavior, price movement stops being noise and starts becoming information. This concludes episode 2. The foundation is now deeper. The next episode builds on this clarity.
Thank you for watching. Like, share, subscribe to get more like this videos.